Well, let's get a feel from the trading floor of the Chicago Mercantile Exchange, where trader Peter Yastrow is standing by. He's a market strategist and principal at Yastrow Origer. Peter, good to see you again. Give me a quick take on what you're hearing on the trading floor relative to the jobs report. It did seem like investors were maybe a little overly optimistic going into this monthly report.
Yeah, everyone was really excited for a strong number today. Don't get confused by the unemployment rate dropping below 9.5%. That's not what they looked at. They looked at the creation of new jobs, the non-farm payroll numbers. As of yesterday, there were rumors through the market that we could see a number as big as 400 or 450,000. So everybody was excited coming in today. It was really, it was palpable. You could tell everyone was excited. Maybe 2011 was going to be quite exciting, especially in the interest rate quadrant here at the Merc. And when this number came out, you could hear a groan across the whole floor as everyone just realized that, as we all really understand and are afraid to, I think, acknowledge, that just because the Fed has done all this financial alchemy and cut rates to near zero, it does not give us an opportunity to hire people or grow our businesses with any confidence. It just gives us a chance to take advantage of really low rates for a while. And that, unfortunately, is not leading to any new hiring. And, you know, it's causing a frustration and consternation for the Fed at the same time.
All right, Peter, hold on right there. I'm going to bring in another guest that we have today to join in on this conversation, Scott Brown. He's chief economist for Raymond James. He's coming to us live right now from St. Petersburg, Florida. Scott, good to see you. Thanks so much for joining us. You're one of Bloomberg's best, one of the most accurate forecasters we have out there. Let me ask you, what did you think about today's jobs report? Were investors a little too optimistic?
Well, I think they were following the ADP. I mean, the ADP numbers don't do a really good job month to month in forecasting the official BLS numbers. The payroll number itself that we got from the BLS was disappointing. You did get an upward revision to the 2 previous months. That takes a little bit of the sting out. And we'll also get annual benchmark revisions to the establishment survey data next week, so who knows, the story may change. But I think it's consistent with the view we've had all along, that is, the economy is continuing to expand, but just not rapidly enough. I mean, we need to really see much stronger GDP growth, much more substantial job growth over the next several months. It just doesn't seem like that's likely anytime soon.
Scott, where do you expect the unemployment rate to go by the end of the year? I mean, I know no one's particularly excited about this 9.4% rate, although it was a significant drop. I mean, what's your take on that? And when you're forecasting going forward, what do you expect to see?
Well, the drop that we saw in December could be due to a couple things. One is you had a bump up in November, so it could just be a statistical unwind there. In addition, during the first part of the month, we had negotiations going on about the tax cut agreement. The extended unemployment insurance benefits had lapsed. Part of the condition to receive unemployment insurance benefits is that you be actively looking for a job. That's the same definition the BLS uses to be classified as unemployed. So as those benefits lapse, you're going to get a lot of people dropping out of the labor force, and as a result, the employment rate drops. If you look at the employment population ratio, it edged up only slightly, and I think that's probably a better measure month to month because it gets rid of a lot of the noise in labor force participation. That said, I don't think we're really looking at a lot of improvement in the unemployment rate over the course of the year. We really need to see GDP growth on the order of 4, 5, 6%, and it doesn't seem likely that we're going to get that. We may see better job growth in the second half of the year. Hopefully things will pick up steam. But it's a real tragedy because you've got a lot of people that aren't really getting the skills that they normally would get as people coming into the workforce. You've got people that are losing work skills the longer they're unemployed. And there's not a whole lot that officials can do. I mean, we can talk about more fiscal stimulus. I don't think that's going to happen. The Fed's done about all it can do. Ultimately, it's a private sector. You have to look to the private sector for a complete recovery here.
Scott, hold your thought right there, because I do want to turn back now to Peter and bring him back in and just talk a little bit about investors. I mean, investors have been able to shrug off any negative data on the economy over the last couple of months. I mean, we had a great year in stocks for 2010. So, Peter, what's your take or your forecast over the next few weeks? Do you think we'll see investors sort of shrug this number off come Monday?
Yeah, I really do. The biggest factor affecting stocks has been that profits held up while the Fed cut interest rates. And as long as the profits are still there and the interest rates are going to be remaining low for the time being, then you really don't want to take any profits on stocks or start exiting. Equities with the dividends they provide us are the best place to be. And these low interest rates are giving companies an opportunity to rebalance to refigure their balance sheets and income statements. You know, they take on more debt, they retire their equity. So the low rates are definitely helping corporations, and they are making stocks still a buy here. But it's not going to lead to more or better jobs. So if you're betting on your brother-in-law or your neighbor to get a job here, I wouldn't do that. But if you want to bet on the industrial average, then yeah, I'd take that bet.
Okay, hold on right there, Peter. I want to go back to Scott and quickly ask you, Scott, in terms of your GDP forecast for the year, what are some of the big risks out there on the horizon?
Well, oil prices are always a wild card. We're seeing average gasoline prices above $3 a gallon. That may have some restraint on consumer spending growth in the near term. We're seeing, obviously, continued strains in state and local government budgets. If you look at the payroll numbers we got today, another 20,000 decline in state and local government jobs. That's been roughly the average over the last 12 months. Normally, we'd be adding about 20,000 or so jobs at the state and local government. So it's not enough to push us into a recession, but it's not helping at this point. You've got the federal fiscal stimulus, which is going to be ramping down. So there's a lot of risk still in the short term. I think more risks than to the downside than upside. But I do think positive momentum is likely to build over the course of the year.
All right, Scott, Peter, thanks so much for joining us on this Friday. Have a great weekend. Thanks to Peter Yastrow, who's joined us several times now from Yastrow Origer, and Scott Brown, chief economist at Raymond James.